Hi, my name is Matthew Owens. I'm a California licensed CPA and full-time real estate investor. I run a company called OCG Properties, where what we do is we sit down with our individual clients and go over their individual financial situations and goals with pertaining to real estate investments and finding a positive cash flow investment stream that they can get to cover all of their expenses so they can retire comfortably and not worry about some of the economic problems that are going on in the economy. We go through and have a completely turnkey system available for our investors. So we do all the property analysis and due diligence on every investment. We do the property acquisition. We have a local network and team in place on the ground. We have a guaranteed tenant, and we help our investors with the exit strategy and the financing on every investment. We also, which is really, really important, have in-house property management group on the ground out there, pro management group. They take care of and control all of the assets to make sure they're all protected from vandalism, theft, from anything that could possibly happen out in the market. Now, all of our investments come with positive monthly cash flow, have built-in equity, they're fully renovated, and have a tenant in place. We also run a nonprofit organization called the Good Life Foundation. And what the goal of the Good Life Foundation is to teach our tenants financial literacy, do credit repair, do resume building, personal budgeting for them so that they can become homeowners and actually live the American dream as well and own a home where all of their monthly payment is not going towards rent. It's going towards a mortgage that they can pay down and own the home one day. That being said, I'm going to take you through one of the investments that we have available right now for a joint venture investment with us. So in this investment is 1757 Capri in Memphis, Tennessee. It's 1189 square feet, 3-bedroom, 1 bath. It rents for $850 a month, and the estimated market value is $90,000. Now the total all-in cost, renovation, purchase price, closing costs, appraisal, all of the extra costs that go into this are total $58,500 because we have relationships with asset managers and REO agents that we can pick these up for cash, and we go through and buy these things and rent them out and help our investors in joint venture with them. So the goal of this investment is to purchase it, renovate it, and then tenant it, and then sell it with seller financing to another investor that's going to come in and put a really large down payment on there. And I'll show you a little bit about that in a second in the numbers. But the total investment is $58,500, which is 65% of the estimated market value. Now for that, we do all of the work, and the investor gets 75% of the cash flow from the rental income and the note, and then 50% of the loan payoff after we actually, after the investor that we sell it to pays us off at the end. So let's look at some of the numbers here and show you how you can create an amazing return with really, really low risk. So first thing, we go through and we sell the property for $81,000. That means the investor's going to come in and put $45,000 down. And we're going to loan them $36,000. Now keep in mind, all this happens after we renovated the property, after the investor puts in their initial $58,500, and then we go sell it to another investor with seller financing. They're putting $45,000 down when someone else is buying it for $81,000, and we're loaning them the other $36,000. We're going to be the bank. And we're going to loan them that money, and they're going to pay us a payment of $216 a month for 5 years. That's a 6% interest rate, and we're going to amortize it over 30 years, so they're paying a little bit of principal down every year and every month. So that being said, let's look a little bit more at the numbers. So the initial investment for you is $58,500. Now we get $45,000 back from the down payment that goes back to you as the investor for putting the money up. Now, keep in mind, we have some closing costs and some commissions that we have to pay, so the investor's total cost here that's left in the deal for 5 years is only $17,500 out of the initial $58,500 capital infusion. Okay, so now you're only in it for $17,500 for 5 years. Now let's look at the returns. They're absolutely phenomenal. So we're getting a payment of $216 a month. The investor's share of that is 75%. So they're getting $162 a month, which is $1,944 a year. That's an 11.11% interest rate on your money. And you're secured by the property with a loan of $36,000, and you're only in it for $17,500, which is only about 19% of the market value. Talk about low risk in that kind of a situation. We're not doing the 3% down FHA financing deals. So in 5 years, they have to pay us off $33,500. So it paid down from $36,000 down to $33,500 during the 5 years. And now we reimburse the investors $17,500 first before any profit splits are covered. Now we go through and we have 16 grand of additional profits that split 50-50 between OCG Properties and you as the investor. So over 5 years, you're making $17,720, which is above a 100% return in 5 years. That means on average, every year you're making $3,544, which is a 20.25% average annual return. And I'll show you in a minute why it's really, really low risk. And there are ways to increase your return and decrease your risk if you have control over the asset. Okay, so let's look at, why would a buyer do this? Why would a buyer come in and put $45,000 down on an investment where they're getting a $35,000, $36,000 loan? Okay, so a lot of these buyers that are buying this are foreign investors who don't have the financing, the U.S. financing capabilities, or they're self-directed retirement accounts that can't go get financing. Okay, so we will loan to those types of people, and there's a lot of people with a lot of money but with really low credit right now because they just got hit recently with a lack of job, but now they have money available. Okay, so the gross rents, and keep in mind, we get to keep this before we actually go sell the properties with seller financing. We get to keep the monthly cash flows that are coming in on the rents until we sell it. So it's a performing asset while we sell. So $850 a month minus vacancy, management, property taxes, insurance, repairs. The net monthly income is $487 a month. That's $5,844 a year. After they're paying their $216 a month, they're making $3,253 a year, plus their depreciation benefits and the principal reduction. They're making $4,519 a year, which is about a 10% interest rate on their money, excluding the equity because they bought it under market value. So that's a lot of great positives here. Now let's look at in a summary. So what really happens? You invest $58,500. Okay, we renovate and tenant the property. We sell the property to another investor with $45,000 down. Now you get back $41,000 of that initial investment, so you're only in it for $17,500. So that means you're in it for $17,500 for another 5 years. The buyer owes us $36,000 and pays us $216 a month for the 5-year term. After 5 years, they have to pay us the remaining balance of $33,500 that they owe us. And what we do is we go through and pay back the investors $17,500 first before any profit splits. After that, we split the investment 50-50, and you've just made 20% plus average annual return on investment secured by real estate at 19% of the market value. Absolutely amazing security. So let's go over some of the risk mitigation really quick. So if we can't sell the property to a buyer, we collect the cash flow. The total investment is $58,500, which is 65% of the market value. The total investment after it's sold is $17,500, which is 19% of the actual market value. It's managed by our in-house property management company to protect that asset. The buyer, if the buyer doesn't pay off our loan, which would be really dumb of them because they just put down $45,000, we get to foreclose on the property. And I say we get to because it costs us $2,000 to actually foreclose on a property in Tennessee. And our cost is only $17,500. That means we're going to be in it close to 20% of the market value of that property. You can make a huge profit if they don't pay us off. You and OCG, which is my company, are put as the loss payees on the insurance policy. So if there's a fire, anything happens with the property, we get paid our lien amount first, and then the investor gets paid the remainder. If the buyer stops paying, we have the right to collect the money directly from the tenant themselves, directly from the management company, and I put that in the loan agreements. We've purchased over 125 of these already in the Memphis market, so we're not learning on your dime. We've done this enough times to know what we're doing. Memphis is not a volatile market as well. So you look at the economics of the market, and it's looking like major significant job growth in the near future. FedEx has their headquarters there, so it's a central hub of the U.S. We go through and we look at the economic growth, the job growth, the affordability index, the rent to price ratios in the area. That's why I invest there and live in California. I invest, like I said, I invest where it makes sense. And the property is the collateral, and it's fully renovated and managed by our in-house property management company, so we can protect that asset. That being said, that's the review of this investment. If you're interested, give us a call at 424-757-4680. You can ask for me. My name is Matthew Owens. Or you can email us at invest@owenscg.com. That's invest@owenscg.com. Hopefully, I'll hear from you soon, and have a great day. I'll talk to you soon. Bye-bye.